Bloomberg Audio Studios. Podcasts, radio, news. You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Again, the big story on the M&A front, Electronic Arts going public via an LBO. How about that, kids? $55 billion. JP Morgan advising Goldman Sachs on the other side of the deal. JP Morgan writing a $20 billion check to get this deal done. What's it mean for the gaming business? Nathan Naidu joins us here, technology research analyst for Bloomberg Intelligence. He's based in London. Nathan, how's this price tag look for you? How's the valuation here?
The valuation is at a 20 to 30% premium versus the last three-quarter market cap before this deal was announced. And it seems like, it is a premium deal, but actually, EA has a lot going for it. Right? It is actually launching a new Battlefield game, and there's a strong prospect for this game. And actually, the game is now in pre-release, and even then, it has already smashed all prior records set by the biggest game in that genre. And that genre is first-person shooter, and that game that has dominated that genre is Call of Duty from Microsoft. So Battlefield 6 is looking to be a successful launch. And next year, we have FIFA. And obviously, we know that EA has the biggest soccer game in the industry, and that's FIFA. What was called FIFA, but now it's called EA Sports FC. And next year, FIFA World Cup will be a special one because it will be hosted across 3 cities, including the US. And if people don't know, US is actually the biggest market in terms of revenue for all kinds of sports games. So that's the second thing going for EA that I think it's going to lead to at least 2 rounds of consensus beats on EPS, earnings per share. So I think for EA, this is actually a good deal, and we can talk about the common struggles faced by game publishers and how these deals would make sense for EA as well as the investors in this context.
So yeah, let's do that, because you mentioned a bunch of the titles, and these are very valuable franchises. This is top quality IP, whether it's EA Sports FC, Madden NFL, The Sims, Battlefield. What does ownership by private equity, by private investors, allow EA to do that it can't do as a publicly traded company?
I think it's all down to funds. Game publishers in general have been facing 2 struggles. First one is gamers' attention span and playtime are increasingly getting limited. The reason is people are sticking to brands or franchises that they have played for a long time. And in fact, Newzoo published a data saying that 80% of playtime tend to go back to the 60 or so titles, leaving only 8% of playtime for brand new IP. And this is actually in favor of EA because we mentioned those valuable IP. In fact, if we look at global unit sales, EA has has 4 of those top 20 selling IP globally. It has 4 out of the 20. So that is actually a pretty enticing deal thing for companies like private equity because profit generation is key. And what this means is that EA has franchises that can bring in recurring revenue. We talked about EA Sports FC, we talked about Madden NFL, and they actually revived a new franchise, college football. And it was one of the best-selling titles in the US last year. So recurring revenue is key here. And the second struggle that I was going to go into is development cost is really high, especially in the US. So that means that Western publishers actually have a cost disadvantage when compared to Eastern developers. For example, salaries for game engineers in China is more than half the level in California. And personnel cost, game engineers is a huge part of developing a game. So, Tencent actually launched a new game in the same genre as Battlefield 6, and that's Delta Force. It's doing really well. And what that cost disadvantage is stopping EA from is continuously to push out a strong cadence of content to essentially extending the shelf life of any game. And Eastern developers can do that better because of that cost edge.
Stay with us. More from Bloomberg Intelligence coming up after this.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Carnival Cruise Line raised its full-year earnings forecast for the third straight quarter, citing a record pace for forward bookings and improving net yield. So what's the stock do? It trades off 3.5%. Go figure. Maybe our next guest can help us out here. Brian Egger, he covers the gaming stuff, the lodging stuff, the cruise stuff, all the fun industries out there. He's been doing it on Wall Street for a very long time, one of the top folks in the street in his industry. He's Bloomberg Intelligence, joining us live here in our Bloomberg Interactive Broker studio. Brian, Carnival, it seems like, pretty good quarter for them. What'd you hear?
Yeah, very strong third quarter. They're 50% booked for next year. So on the surface, these results are really good. And it was initially a bit of a head scratcher to see the sell-off. I think there are two ways in which maybe they're being perceived as conservative. The one is that their yield growth guidance for the fourth quarter, while it's certainly very solid in there in the mid-fours, it's a little bit below consensus. Maybe the street got a little bit ahead of itself. The second thing is, for all their optimism about bookings and direction of yields, they are very conservative in how they're deploying capital. They've only got about 1% annual yield growth for this year, the next 2 years. So they're growing very effectively, but they are also very measured in how they deploy capacity. So all this is really good, but they do mention that, they can really be judicious on expense growth because they're only growing capacity at a very modest pace.
Is that a bad thing to be conservative? How does Carnival compare with Norwegian or Royal Caribbean?
Yeah, so if you look at Norwegian, Royal Caribbean, they're anticipating or actually scheduling about a mid-single digit, call it 5%-ish level of annual capacity growth for 2026, 27, 28. It's closer to 1% for Carnival, maybe 2% in 2028. So they're just taking a more conservative tack. And I think they're equally long-term optimistic about their ability to penetrate the vacation market, but they're going about it in a much more measured way. And in that sense, it could strike people as conservative.
Talk to us about capacity. If they added a couple of ships, would they sell them out?
Yeah, certainly their occupancy is back to pre-pandemic levels. Their yield growth against that capacity increase is positive. And we've seen steadily increasing yield expectations throughout 2025. And they've got the free cash flow, but I think they just want to build this out slowly, maybe strike some people as being too slowly.
Hey, not for nothing. This CEO got paid a lot of money here. Josh Weinstein, $14 million in cash compensation for calendar year 24, $14 million in stock, $28 million to drive a cruise ship around. That's not too bad.
Nice job if you can. Nice job if you can get it, right?
Not bad.
So here's my question to you, Brian. How do Royal Caribbean, Norwegian Cruise, and Carnival, how do they grow their market? Are they stealing from each other, or is there still a big base from which to grow?
There's definitely a penetration opportunity. Let me just back up for a second. On Carnival, their goal is to become investment grade. So part of the conservatism I think you're seeing, which may be a head scratcher, is they want to get to investment grade. And I think that's probably priority one, shifting some of the enterprise value from bondholders to equity holders. That being said, yes, they see opportunity to grow a relatively under-penetrated overall vacation market, but they're going about it with kind of balance sheet being front and center, if that helps at all. Yeah.
The only thing I know about the cruise business is what I learned from Disney, who got into the business 15, 20 years ago, and it's been a great business for them. How do you stratify the cruise market? Now, I'm going to be at the very, very top, mind you, but how does the cruise industry kind of stratify itself?
Yeah, I think they convincingly argue that they are a relatively affordable form of vacation. It's a package product.
Yep.
The value is very good for the consumer. But it runs across different tiers, from luxury side, Seabourn, Windstar, Oceania, Regent Seven Seas, to the more mass market like Carnival Cruise Line, right? So they run the gamut, but the overall spectrum tends to be generally, relatively affordable, and part of that package vacation product, people buying cruises beforehand, buying stuff on the cruise with a good share of wallet left over, that works to their favor.
How brand loyal are cruising fans? If you are a Carnival person, are you a Carnival person for life?
Yeah, there's certainly some brand loyalty. And remember, they've got kind of, as an industry, companies got two goals. One is to drive bookings for their particular brand, and they do that through new hardware with all the bells and whistles. The other is to drive the overall awareness of the value of cruising relative to other forms of vacationing. And so, they've kind of got that dual mandate.
So you're sitting on the Jersey Shore Sunday afternoon around 5, 6 p.m.
So if you're Paul Sweeney sitting on the Jersey, okay, go ahead.
All this, every Sunday during the summer, you'd see this massive cruise ship coming out of New York Harbor. I think it's the Star of the Seas.
Yeah, that's a new one. Yep.
Thing's massive, dude. Yep. And they filled that thing up.
Oh, just remember that's a Royal Caribbean ship. But I will point out that one of the things Carnival's pointing to is, they reached a 13% return on invested capital this year. So they're kind of getting to that double-digit return pace that they targeted. So their argument would be that they fill it up, they get good pricing, and relative to their investment, they're getting solid low teens returns on incremental invested capital with an opportunity to take that higher. So as long as they can get that return, I think they can convincingly say we're getting there. But obviously, in the case of Carnival, through relatively conservative capital deployment.
I mean, star of the sea, icon of the seas. They have a massive passenger capacity with the ability to hold over 7,600 passengers and a large crew. Man, for somebody who doesn't like people like me, that's a tough sell.
It's not the misanthrope's favorite vacation activity, but they do get good economies by absorbing those fuel costs. And
how big those things are.
Well, I'm always talking with my friend who suggests that instead of retiring to a nursing home or a retirement community, just go on a cruise ship.
Yep,
I've
heard that too. Who's a big cruiser is Charlie Pellet. And he doesn't like cruise the Caribbean. He always cruises like
adventurous places.
Yeah, like I'm cruising to Turkey and I don't know, Antarctica.
The exotic itineraries. Yeah.
Yes, that's what Charlie.
People pay a premium for those. So,
yeah.
Oh, so he's that kind of cruiser.
Yeah, well, I'm just saying, on average, the customer pays a premium for
You talk about going investment grade. Again, day one or day two of the pandemic, who were the first companies going to the bond market? The cruise industry. Because those companies knew, oh boy, this is not going to be good for us.
Well,
we need this.
Back from that brink and therefore trying to run the business in a measured way.
Stay with us. More from Bloomberg Intelligence coming up after this.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
AI, and we're talking technology, you're talking AI, and people are trying to figure out how do you get exposure to it beyond the chip manufacturers like at NVIDIA, maybe beyond some of the software players like Microsoft. Well, how about computer hardware and storage? Go figure. We got somebody here who can help us out on this stuff. Jin Ho, Bloomberg Intelligence Senior Technology Analyst. Let's talk about some of this hardware and storage companies that you cover. Supermicro is one of those companies that stock has done really, really well this year. Talk to us about that company. How do you approach this company, Supermicro Computer?
Yeah. Hey, Paul. So Supermicro has actually been a very controversial name throughout the year. But at the end of the day, they're highly exposed to the $312 billion AI market. The fact of the matter is, even though they've had choppy execution, they are one of the market leaders there. And as these deals come through, I expect Supermicro to continue to be involved in those deals and possibly win their fair share.
I'm just looking at your research, which you can do, folks, going BIGO on the Bloomberg terminal, and that's where you access all the Bloomberg Intelligence investment research. You write, Supermicro's AI rack system expertise and its short delivery times position the company to boost sales 74% to $31 billion in 2026. That is extraordinary.
Yeah. So, look, if you think about some of these hyperscale cloud providers, as well as those neoclouds, and neoclouds I define as these newer AI infrastructure as a service vendors like a CoreWeave or a Lambda. Time to market means a lot, right? And if you can't deliver the equipment to their specs in a timely manner, you're not going to win those deals. There are actually two companies that have done that. Supermicro is one, and Dell. So if you can ship the AI servers, get the GPUs as quickly as possible, the likelihood is you're going to win the deals. Now, keep in mind, these guys were only generating roughly $3 billion in revenue about 5 years back, and now we're talking about revenues closer to $40 billion in fiscal 27 and $33 billion in fiscal 26.
It's extraordinary. And just Supermicro, the stock is up 50%, 52% year to date, so it's just extraordinary. All right, when I think hard disk drive, I think of the little thing in my PC under my desk, but when we're talking about the cloud, we're talking about something totally different. Talk to us about kind of the hard drive that a company like Western Digital provides the stack.
I will tell you, we've been very bullish on the hard disk drive market for a couple of years now, and it's really starting to materialize. Not only Western Digital, but also Seagate. If you think about the hard disk drive market, we're talking about a $40 billion in revenues, split in roughly 40% of it going to Western Digital, 40% of it going to Seagate. And at the end of the day, a lot of the data that's generated by AI needs to be stored somewhere, right? And it's going into the Western Digital drives as well as the Seagate drives. And if you see the last month, the AI story has really started to materialize. Western Digital stock is up about 40% over the past month. And because of the strong demand by the hyperscale cloud providers, these guys have lead times of over 8 weeks, visibility going into 6 quarters, and this is leading to price hikes. This is a commodity market that tends to have 5% annual pricing declines. Pricing will stay stable. Not only stay stable, it's probably going to rise over the next 6 weeks.
I mean, you've been bullish on Western Digital for a couple of years. I missed that. Too bad for me. Year to date, Western Digital stock is up 155%. And this isn't a penny stock, folks. This is a company with a market cap of $40 billion. So, Wooch, from your perspective on the hardware networking side of the business, kind of where are we in this AI play? What are your companies kind of telling you?
Yeah, a lot of my companies are telling me it's still in the early days, right? But it's also going through a lot of disruptions as well. And some of the, I guess, legacy companies like Cisco, like an HPE, it still considers a smaller fraction of the business to really make any impact, but they're going to be involved in some way or another. Now, in terms of the hyperscale cloud providers, they are a small subsegment outside of the GPUs that are going to benefit. The optical names in particular, because there is this need for speed to traverse the data, to have the data traverse through the networks. My colleague Jake Silverman, he covers those optical names. Companies like Coherent, companies like Lumentum, they've actually benefited quite a bit. From a hardware perspective, Arista Networks, they have strong exposure to companies like Meta, and they have they've actually seen their stock double over the past year or so. And also another small company called Celestica, based out of Canada, they've been beneficiaries from this AI spend.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.